Sonal Varma joining us this morning, Managing Director and Chief Economist, India and Asia, ex-Japan at Nomura. Sonal, great to have you on the show, and thank you so much for joining in today. So much to unpack, including tariffs, including the big, beautiful bill. Let me start with this finance bill, which has been passed in all layers in the United States. What is the impact that you see?
Well, at the margin, it looks to be slightly more fiscally expansionary in the near term compared to what we had anticipated. But over the more medium term, we don't expect any material impact in terms of the outlook on US growth or inflation. We haven't therefore really changed our baseline projections for US growth. We think there are headwinds coming through in the coming months in US as tariffs do lead to higher US inflation. So some of the fiscal impulse in the near term will be offset by weaker consumer demand, as well as our view that business investment will slow down because of uncertainty. So our baseline still is that the Fed is going to be on hold until the first cut in December. So no material changes in terms of the near-term projections. Medium term, the focus on fiscal sustainability and dynamics in the US still remains a big risk that we are monitoring.
Hi, morning, Alex here. I'm just wondering then, given that your base case does not change, I'm just wondering how you look at all of the data points that are emerging, not least of which the latest jobs print. Because while that headline looks okay, if you look under the hood, that private sector jobs seems to be concerning a few people. How are you looking at that? And do you see the next few prints reflect what you are suggesting, the impact of tariffs, etc.?
Yes, absolutely. I think as you said, the headline jobs was quite strong, but a lot of that actually driven by state and local government, and in some of the sectors which are more acyclical in nature, whereas some of the more cyclical sectors like manufacturing actually saw a contraction. And the private sector jobs creation at a fairly subdued 74K. So the underlying momentum in the jobs market actually seems to be one of the labor market cooling down, even though the headlines have come in better than expected. So we do think that over the coming months and quarters, we will see more signs of labor market in the US slowing down. So we are penciling in the unemployment rate, which surprised at 4.1% yesterday, for that to inch up to around mid-fours by the end of this year. So that's one. And in terms of the tariff and inflation, so it's been a positive surprise in that inflation has remained benign despite an increase in tariffs. Our suspicion is that the manufacturers are still running down existing inventory, and therefore the full impact of the new products at higher tariff rates is probably going to take another month or so for the impact to show up. So we are building in a pickup in goods price inflation in the US, perhaps likely to show up from July, August onwards.
Sonal, good morning to you, Neeraj here. So we don't know the finer details of what deal gets struck between India and US, right? But I'm just trying to ask you, based on your assumptions and assuming that those assumptions turn out to be true, what could be the implications for India out of this? Because I think we've drawn a line around protecting industries which have a higher job implication, I believe, and therefore maybe that line isn't crossed per se. But based on your assumptions, what's the impact?
I mean, most of the deals we've seen so far, details have been very limited, including the announcement of the US-Vietnam deal in principle, yesterday. So we'll need to obviously wait for the details. I think there are a few things that are important for India. One is where do we reset on the reciprocal tariff rate vis-a-vis the 26%? For instance, Vietnam, the baseline now is 20%. So if India can get its reciprocal tariff rate, let's say closer to 10%, which is the universal baseline, then the tariff gap between India, Vietnam, and maybe some of the other competitor countries will favor India. And for product categories where we compete with Vietnam, things like textiles, electronics, footwear, potential area being toys as well in the future. For those potential areas, we could get some tariff advantage, because the idea here really is to increase our export market share in these product segments. So that's one we are watching. Second are the rules around transshipment and rules of origin and local content requirement. Again, this is not clear in terms of what specifically the 40% on Vietnam's transshipment, the true definition is, because typically in these deals, there is a clear definition in terms of what the local content should be to qualify as Make in India. What this will do is disincentivize over time the foreign value addition and incentivize more local value addition in the products that we are exporting. So that could be basically a trigger to create more domestic backward integration across different sectors. And of course, if we do see a reduction in the tariff lines across many product categories, then that opens up a market opportunity for different segments, whether it's on the auto component side, on the textiles, gem and jewelry. These are some of the big export sectors for India when it comes to US as the end market. So right now we're waiting for more clarity on some of these things to assess to what extent India will benefit from the relative tariff advantage. And to what extent the deal is a tailwind to India's China Plus One strategy.
Sonal, what's the worst case scenario here? You've outlined what we hope we will see in the next couple of days and the advantage that comes to India. But looking at how one-sided the deal with Vietnam is, what do you think is the worst case scenario? And of course, you've already described the best case scenario.
I think, of course, no deal, and if the tariffs reset at 26% is sort of the worst case scenario, because that would put India at a relative disadvantage compared to our competitor nations. I think the second thing to watch is to what extent we open up the markets to more competition from US products. There could be, this is more of a, I would say, sector-specific increased competition risk rather than an aggregate negative for the India economy. So there could be specific sectors where, because of lowering of India's tariffs on US exports to India, there is greater competition for some domestic sectors because of this tariff reset. It's great in the medium term because it forces companies to be competitive, but near term it could lead to more margin pressure. So the worst case scenario, Tamanna, is really there isn't a real deal and we reset either back to 26 or something that's closer to, let's say, 20, which would basically put us at par with Vietnam.
We look forward to our conversations with you, Sonal. Last time we spoke was before the monetary policy on the 3rd of June, I believe. And we had spoken about where you see the repo rate culminating. And your projection was 5%. Please correct me if I'm wrong. And I want to know whether you are anticipating a 50 basis point or whether it caught you a little off guard. And do you stick with that 5% based on what you've seen so far?
50 basis point was surely a surprise, and 50 with the change in stance was a bigger surprise. We still expect 5% as the terminal rate. Given the front-loaded cut and the guidance, we do think the bar is quite high for August, so we are expecting a pause there. But in terms of our baseline projections, the domestic cyclicals are not yet showing a decisive sign of an upturn. And some of the global trade slowdown, as we discussed, US moderation, a lot of that we think is ahead of us. So while India will gain relatively in terms of export market share in certain product categories. Moderation in global trade will also be a negative for private capex. And we do think that the policy transmission in terms of these lower rates leading to a turn finally in the credit cycle will be long drawn because demand for credit has actually come down, even though the supply side in terms of availability of more liquidity, etc., is improving. And finally, we expect inflation to undershoot compared to the RBI's projection of 3.7 for FY26, the midpoint target of 4. Our own projection is inflation will average closer to 3%. So we also see an inflation undershoot. So we are expecting the rate easing cycle to resume in October. So we have 25 cut in October and another 25 in December.